external reorganization. Now, the moment you hear external reorganization, we are talking about what? Business, or some may also term it as what? Amalgamation. Now, so you should know, you should understand the distinctions. Let me take you back with regards to when we say external reorganization. The internal reorganizations are what we did over the period with regards to reconstruction, capital reduction, and so on and so forth. Do you remember them?
Yes, sir.
Good. When we say external reorganization, that is where now we want to reorganize the business. It is an external body or business that is going to take over the business. That's why we term it of external reorganization. That is, let me say, the basic explanation to that. So here, when we see amalgamation of a business, amalgamation of business where two combine resources together to form what? So example, like if you have, maybe you have company A and what? Company B coming together to form a business called what? Company C. We call it what? Amalgamation. Because you understand.
Yes, sir.
So that is what that means. Now, we also talk about what? Business takeover. So the business takeover is where you have what? Company A coming to take over what? Company B. Because at a point, maybe if company B is not doing well, company A can come and will take over what? Company B. Do you understand? So that is all
Yes, sir.
about external what? Reorganization. That is all about when we are talking about external reorganization. That is what basically it means. When you are doing external reorganization of a business, follow me here. When you are doing external reorganization of the business, things that you should put at the back of your mind, right? So here, things you should take it at the back of your mind, and what? And the seller in these transactions. The buyer is the acquirer, and the buyer is what? So you should understand these things. So he is the what? He is the one acquiring the business. Or if you don't see acquirer and you see transferor or transferee, is the one who is buying. Now, when you come to the seller, no, so when you come to the seller is what? The acquiree, transferor. To take note of some of
Yes, sir.
these terms. Now, when we are doing external reorganization, unlike the internal one, when we are doing the external reorganization, these are the things that you should take, you should look out for. Some of the account that you should look out for. I'm coming to divide them into two. I'm coming to look at the one who is selling, the account you need, and the one who is selling. So the seller, right? Under the seller, these are the accounts that what will be open under the seller. And under the buyer, these are the account that you need. So you have also what? The buyer. Now, let us look at it. Under the seller, you will need these accounts, right? You will need account called one, realization account. Two, sundry members. Sundry members account. When we see sundry members, they are the same as shareholders. And then three, you have what? Bank or cash account. Now, when we come to the one who is buying the assets, you need what we call purchase consideration. what we call purchase consideration. And this purchase consideration at a point can also have some bit of what capital account in there, but don't let me belabor that point. So you need purchase consideration. You also need what we call goodwill, bank or cash account of the what of the buyer. You also have, so here you have bank account, cash account, goodwill, purchase consideration, and statement of what financial position. These are the what the main account that that have to be featured in the preparation of external reconstruction.
Yes, sir.
Yes. So these are what you should look out for. What the term realization account. So the realization account is where the one who is selling the business to the acquirer, the buyer, the seller is to the acquirer. This is where we will list all his asset and liability, right? Now, when we list all the asset and liability, whatever the balance is left can be a gain to the seller, or it can be a loss to a seller. A gain to a seller during the selling of the asset, or it can be a loss to the seller during the period when the asset is being sold. Now, I will explain this further. Now, when we come to sundry members consist of it account for the shareholders' stake, how much shares they have sold out, and how much shares that they have right now in the account of the one who is buying the asset. So let me explain this again. You see, when the buyer is acquiring this company, he will acquire all the assets, right? He will take all the assets, and then both two companies will decide on the liabilities and so on and so forth. Now, during the process of acquiring this asset, the one who is buying the asset will give the one who is selling the company shares, so that they can be part of this company, because it's an reconstruction. They are reconstructing the company. Do you understand? Buying it, acquiring doesn't mean that those people who are in this company, because this company is not doing well. You understand? So external body is coming to restructure it. So when they are the process of restructuring, they will have to manage the equity and liabilities. So during the process, they will tell you that if so, we are acquiring this company. So your shares that you're already having, they will change the face of the shares that they have for you. So all that they will say that, okay, now we are going to give you guys shares, so that you become part of the new company that we are creating. You understand? So that is where we account for the shares that are going out and shares that the shareholders will be holding in the new company. Now, when you come to cash and bank, that is where you have to balance your account between sundry members and then and the bank or cash. Here, all your cash balances that you already have. Now, out of the cash balances, listen very carefully. Out of the cash balances, if there is a balance for you to pay from your account, what I mean is loss on realization. When there's a loss on realization, you have to pay from your cash. Maybe you have payables in your account, and these payables, by the end of restructuring, they agree that they will pay you have receivables. By the end of at the end of reconstruction, they will say that they will pay the receivables. You receive it as cash in. Now you have payables. By the end of reconstruction, maybe these people who are taking over have said that, okay, these payables, if before we finish reconstruction, if you, the company, were able to settle the payables, then maybe we can give you a certain rebate or discount on what on your payables. Then the seller said, okay, then you pay at a discount. When they pay, you pay it out of what? Out of the cash. During the reconstruction as well, if the buyer did not take the what you call reconstruction cost, you will have to settle it. You understand? So when you are settling, you will settle it in your what? Cash account. If you have unpaid dividend before reconstruction, you have to pay it out of your cash. And there are other expenses that you have to pay out of your cash. So that is the existence of what it is. So this is the nature of this. Now, when you come to the buyer has what you call purchase reconsideration. So the purchase reconsideration here means that how much is the what is the new company bringing on board. You understand? So here they will say that, okay, we want to acquire this company. So how much are they bringing on board to be their capital in this very company? You understand? So that's where the purchase consideration talks about. Whenever a company is acquiring another company, how much they bring on board to acquire it, what we call purchase consideration. Do you understand? Okay. Now, goodwill. Where do we get the goodwill? You have your purchase consideration. Then we compare it to the asset of the what? Of the one who is selling the what? The company. You understand? So there you get the goodwill. So here you will need to look out for all the assets of what? Of the seller, and compare it how much the company is actually what bringing on board. So that gives us what? Goodwill. Goodwill can be positive and it can be negative. Now, cash or bank. So cash here means that maybe during the process, the buyer, a transaction can exist between the buyer and the seller. Example like this. The seller can say that, okay, please, our preference shares, listen very carefully, our preference shares acquire 70% of our preference shares. 30% will pay it in cash to you. They are referencing the buyer. So here, when that money is coming in, it will come into the bank account of the buyer. Or the buyer can say also that, please, your preference dividend, I will take it. Or your cost of what? Your revaluation construction reconstruction cost, I will take. The buyer will pay it from cash or bank balance. When you are done, then you will prepare new statement of financial position of what of the buyer. That is the essence of this thing that I'm talking about. Please, have you understood it? Okay, so now that I've explained this one, let me demonstrate something small here, and let us look at it.
Thank you.
Assuming you have statement of what? Company A, financial position. Statement of what? Financial position. Like this. Okay. You have all your what? Non-current assets. So you have your what? Tangible asset. Tangible asset. You have your inventory. You also have your receivable. Maybe 30,000. Please, when you add all these, what do you have? Add them for me, please. 240, like this, right?
Yeah, 240,000, sir.
Good. So let's have it like this. Here is 300,000. You have your preference shares. 3 at 40,000. So at a price 0.2. Okay.
240.
240. Right. Okay. So this is what you have. So here, assuming we don't have any liability. You understand? Assuming we don't have any liability. Or let me add maybe Cash.
So there'll be a reduction, eh?
So
Okay.
it's a cash or bank. Maybe here, receivables. Here was how much? Receivable was how much?
30.
So it has mean like you have receivable of maybe 10,000 and cash was what? 20,000. So when you add that gives you what?
The same value, sir.
340. Okay. So you have something like this. So you have what? Company B acquiring company. You understand? So what is the consequences? You understand? So here, maybe company B will say that company B shall offer shares to company what? Company A 0.5
Company at
shall offer shares to company A. Share price at 0.5 to one share held. Preference shareholders will receive 0.1 to one share held and of their shares and 0.1 will be paid in cash. All right. So this is what you have. So let us go around this one alone. Right. So this is where the headache mostly is or are. Or let
okay.
me say, or let me add one thing that's maybe reconstruction cost is 5 maybe 1,000. Okay. And then the last one maybe receivables of 20,000. Debtors agreed to settle 1,500 if agreed by the what? By the seller. All right. So this is what you have. All right. So let's assume that this is all that we have, right? Please, are you following me?
Yes, sir.
So this is all that you have. Now, when you come, this is first thing that you look out for, right? Okay, the account. Don't forget them. So here you will say the seller. Please, are you with me?
Yes, sir.
You will say the seller. So this is the seller. So the seller is a what? Is a company who is selling. What is the name of the company? Which is what? Company what? Company A,
Company A.
right? Okay. So in the books of company A, what do? Then you come to the buyer, which is company what? Company B. In the books of what? Company B, what do you what do you record? That is right. So if you have, you can divide it, you can do it. If you cannot do, you can make it in separate sheets. So here in the books of what? Buyer. In the book of buyer, this is what you will say. You will see what? Purchase consideration. So the purchase consideration, they decided to offer them shares to the company B, right? Is that to offer them share? Do you remember?
Yes, sir.
So they said that the share that they are giving it to them is what? Shares at the price of what? 0.5 to 1 share held, right? So
Yes,
before
sir.
you do that, go into the and look at the number of shares that the company is holding in that equity. The unit share is what? One series,
One
right?
series.
Total share is 200,000. So this is how they do. So first convert all the shares into all the this into what? Into shares. Do you understand? So how do
Yes,
you
sir.
convert it into shares? So in the
We
number of
divide.
you understand? So you have what? The share capital is how much? 200,000 divided by what? 1. You understand? So that gives you how much? 200,000.
200.
So this becomes your what? Your number of shares, right? And the new share they are offering them is how much? They said at the price of what? 200,000, right? So that's when
Yes,
you
sir.
have your what? Your new share capital, which is what? They said they will offer them what? 200,000 shares. When we read it, what did they say?
The new shares they are offering.
Yes. When we read it, what did I say? Offer
The share
shares to
price.
company A. Share
They said company
price,
B held.
yes,
Company B shall offer shares to company A.
at
Share price
0.5
at 0.5 to one
0.5
share
series to 1 share held.
held.
You understand?
Yes, sir.
So here, or maybe let me coin it. Maybe offer to um to company A share price at 0.5. One share to 2 share held.
Okay.
Like this. Yeah, 2 shares to every 1 share held. Okay, so when you have it like this, so 1 share at 0.5 to 2 share held. Okay, so when you come here, this is what you do. You have your number of shares, right? So you have your number of shares, which is what? 200,000. So you have your number of shares, which is what? 200,000. And they want to offer them what? 2 more shares to every 1 share that they hold. Is that not the case?
Yes, sir.
Okay. So 200,000 here. And they said they will offer them what? One
They'll
sh-
offer them shares. They'll
one
offer
share,
shares to the company A. One
one
share
share
to.
to every 2 share that they hold. That's what they say. Listen, don't forget.
Yes,
That's how it is. They are calculated. So watch it. 1 share at 0.22 share held. That's how it is. What it is counted at all time. The share that they hold will be the divider. Take note of that. I remember.
okay.
Multiply by how much share price are they giving it to them?
0.5, sir.
0.5. Then you multiply. What do you have?
50,000, sir.
So you will have your 50,000 here. Then you come to preference shares. Now, when you come to preference shares, what do you see? That one to you should what? You should convert from what? From the ordinary what do you call it? From the share capital to what? Number of shares. So you have what?
Yeah.
Your share, your preference share
40,000.
40,000, right? So 40,000 share price is how much?
0.2.
0.2. So it will give you the number of shares. How much, right? The number of shares?
200,000, sir.
200,000. Good. Now, out of these 200,000, let us read what I said here. The question I said here. What did I say? It said that the preference share will receive two shares, right? It will receive 2 shares at 0.1 to 1 share held. I will change this one because the number of share is too big. Let me change this one here to what? To be 1 here. Then I change this one to what? To be 3 shares held.
Okay.
You understand? Okay.
Okay.
Okay. At 0.1 series to 3 share held, their shares and 0.1 would what? Will be paid in cash. Obviously, when you add the two, how much do you have? Have you seen that the total number of share price of what of preference share is 0.2? Have you seen it?
Yes, sir.
Look at what I decided. I said the question. I said that they will what? They will pay. They will use 0.1 to buy shares, and then 0.1 what? They will pay it in what? In cash. Do you
Yes.
understand? That's the
Yes,
common
sir.
shareholder. So that's the mindset. So look at what I'm going to do here. Now we are coming to convert part of their shares, their equity into what? Into shares. That's the meaning. And then the part of it, they said that they don't want to convert it into shares, but they what? They will pay.
Physical card.
You understand? They will pay physical cash for it. Okay. So let us go. So after I've done here, so you have your what? Your new preference shares in what? In company B. Share preference share capital. You how much? You have your 200,000, right? Multiply by one share over what? Every three share that they are holding. Then you multiply by 0.1. Have you seen that?
Yes, sir.
Good. Then when you multiply, what do you have?
6,600.
6,600. After we are so we are done with it. Are we, so they are two per the share what do you call it, the purchase consideration, they are two per. When you look
Sir,
at it.
please. It's
Yeah.
666. 46.
Oh, okay.
46, please.
Like this. So they are the purchase consideration, they are two per in the question as I said. Have you seen it? They are
Yes,
only
sir.
two per. The rest are other items that I try to make. So when you are done, then you add it. When you add
The
it,
two
what do you have? Yes, there you two.
56,600.
So 56,666, right? So this becomes your what? Your purchase consideration. Are you with me? Okay.
Yes, sir.
When you are done, you go to Goodwill. So when you go to Goodwill, all you will bring here is what your purchase consideration that you calculated up there. How much? 56,666. Right? Then you come and do what you call you less fair value. Take note of this fair value of what? Of net asset. Just like
Yes,
when
sir.
you are preparing what? Consolidation account.
Consideration. You are this in consolation.
You are doing consolidation. This your net asset. Take note. When you look at the what? When you look at the assets that we have, maybe the moment you say fair value, it means that when you are coming to do the what? The goodwill, when an asset is fairly valued, you need to adjust it to the asset. Assuming like in the they said that tangible asset, part of one of the assets is what fair value of maybe 10,000. So when you come here and you are listing all your assets, you need to add the 10,000 to all your, and because one of the assets is what is fairly valued.
Fair
Do you
value.
understand? Good. And when an asset is also impaired, you need to also remove it because it is impaired. Do you understand?
Yes,
Okay,
sir.
so we will get there. So here you will list all your what your fair value of what net assets. So in the course of doing that, you will have your what your tangible assets. You have your what your intangible assets, your inventory. So this is what I will advise here. The goodwill, if you want it, if you want, calculate the goodwill, calculate the goodwill after you are done with everything. After you are done
Okay.
with balance sheet, then you come and calculate your goodwill. There's a reason why I want you to do it that way. Do you know
Okay.
why? Because
No, sir.
this very goodwill will go to the balance sheet of the acquirer. Tangible and intangible asset must be at what? Must be at what? At the fair value of what? Of the tangible that the person is acquiring it.
Okay.
Do you understand? It
Yes,
must
sir.
be at the fair value of what? Of the value the company is acquiring it. So when we are done with everything, are you with me? When we are done with
Yes.
everything, the fair value of the assets, you understand? Because when we are done with everything, Then we are coming to calculate goodwill. There's a likelihood that maybe the inventory will not be available anymore. You understand? The intangible
Sure.
asset may be, or receivable may not be available anymore. You understand? So whatever
Okay.
is left that we use to prepare the balance sheet of the buyer, that's what we use to calculate the goodwill. Do you understand? So when we get to
Okay,
this
sir.
point, don't calculate the goodwill yet. Calculate the what? Calculate the
Purchase
purchase
consideration. You
consideration.
have.
Then you skip the goodwill. Do you understand? So when you skip the
Okay, sir.
goodwill, then you come here. You can come and do the what? The bank. Let me see. Bank or what? Cash account of what? Of the which company? Which company are we doing here?
B is buying
The B
A.
company. You understand? So when you come here, watch here. They didn't give us any balance of what, because we don't know that one. The one that we are acquiring is what we know. Now remember, do we remember that the preference shares? Do you remember what we say about preference shares?
We're saying that
Part of it will be
with
paid in cash.
the cash and shares.
You understand? Part of it will what? Part of it will be shares, and part of it will be what? Will be cash. So the cash part, how do we do it? Yeah, you come here, you come and debit the cash account of what? Of the company B, the one that is acquiring the company A. Do you understand?
Yes, sir.
Like this. So yeah, when you come here, you will have your what? The preference share that they want to what? They want to pay in cash. We have for preference shares how much? 40,000 divided by what? 0.2.
Point two.
You understand?
200,000.
200,000. Then you multiply by what?
0.01.
0.01. That's what they said. No, check this thing. This one,
Uh,
did they add anything?
no, then we are changing it. New preference share. 1/3.
No, did they? So no, the cash matter. Did they say anything like that? Okay,
No,
okay,
no,
one
no, no.
share. Okay, share, and 0.2 will be paid in what? In cash. So
Cash.
the left. So that's it. So you multiply this one by what? By one. How much is that?
20,000, sir.
20,000. So this one will go into the what? Into the account of what? Of the acquirer. That's all. So we are done with this one. Have you seen that? We are done with what? With the acquirer. Everything is done. So we are left with what? With the balance sheet pay.
Sure.
Right? We are left with balance sheet pay. So what do we do next? So when you look at the stuff that I gave you, purchase consideration, goodwill, balance, and then statement. So when you are done, then you go to what? You go to the what? The one being acquired. Acquiree. So here, I said, what do you open?
Yeah, that with the acquiree, you are
You will
telling
start
us
with
that
what? You will start with what?
acquiree,
You will start with
you
what?
start with the realization
Thank
account.
you. You will start with what we call realization account. Now, when you come to realization account of acquiree, this is how it looks. Debit all the asset, credit all the liability, as simple like ABC.
Okay.
You understand? Now let us do the additions. So first one is what? Tangible asset.
So I'm coming. We say debit or what?
Debit all the asset, credit all liabilities. So when you look at, so the tangible asset is how much?
Tangible asset. 100,000.
Good. 100,000. Now intangible asset is how much?
Intangible asset. 50,000.
50,000. Inventory is how much?
Inventory is giving me 60,000.
60,000. Receivable is how much?
Receivable is giving me 10,000.
10,000. Don't add cash,
Wow.
right? It depends on the nature of the question. Don't add cash because we will open cash account. Remember what I said?
Yes, sir.
You open cash account. So we will make all payment out of that cash. So don't bring cash. Unless, listen very carefully. The moment you will let's say there's a point you can bring cash here or bank here. or bank is acquired and everything is acquired here, the moment you will bring it here, it means that there is no cash balance that the seller is going to pay, because every expenses or cash or payables have been taken care of by the what? By the
The
one
buyer.
who is acquired. Absolutely. You understand? Good. So let's go. So when you are done here, then you also go to the credit side. If there is any liability, you will list all of them here. You understand?
Okay.
Okay. Now, when you are done here, then you add, we have reconstruction costs. That one to your what? Reconstruction costs will come here. It's how much? It's 5,000 in the question, right?
No, reconstruct is 1,000.
It's 1,000, okay. I'll bring it here. And I'll tell you the basis why you are having all these debit and all these credits. So is that all? Let's look through
The
it.
next one, receivables of 20,000.
It will come.
Debtors,
It will come.
debtors are
It will
settled.
come. It will come. It will come. It will
Okay.
come. So when you are done here, watch it. When you are done here, what they mean here is that add all these things. Well, how much do you have?
Come in, say
Oh,
221,000.
good. So you have 221,000 like this, right?
Yes,
So
sir.
this is your total asset that you watch. You own the company that is coming to acquire. How much are they acquiring this company? This is the total asset. Understand? So the one that is coming to acquire should be able to afford this amount, 221,000. Are you with me?
Sure. Sure.
Good.
Or
Now,
more.
come again.
Or more.
Yes, they should be able to afford this value. This is the value of your company, right? Now, if you have liability here, it will reduce this money to be settled by the acquirer. Are you with me?
Yes, sir.
Do you understand what I'm saying? The value of the company is 221,000. Assuming you have payables here or liabilities here, when you balance it, you realize that the liability will reduce this one. That will give you balance carry down here. Have you forgotten?
Yes, sir.
Aha. Because the one who is coming to acquire you shouldn't be the one to take what you call it, will take the asset and the liability in all, but he will pay the difference. You understand? Out
Sure.
to be his purchase consideration. Okay, all that. So at the end of the day, so this is the value of your company, 221,000. That should be the balance carried down for you. So if that should be it, so assuming like, so this is your balance carried down. Watch it. This is also 221,000. It's here. This belongs to you. And the one who is acquiring you, watch here. The one who is acquiring you is now offering you a capital of how much?
It's giving me a capital of 5,666,000.
Are you with me? Have you seen it?
Yes, yes, sir.
So out of 221,000, he is giving you how much?
56.
56,666. So is it a gain or loss to you?
It is not even nearer to the
You understand the
220.
whole thing. Please, you understand?
Yes, sir.
So that's where you have to put an amount. So the person is giving you 56,666. So that's where your purchase consideration will come here. Purchase consideration is what? 56,666.
Six.
You understand? So the person is giving. So this is the total value of what? Of your company, and the person is paying you, bringing in 56,666. You realize that your balance carry down will be at the credit side, which is what we call what? Realization gain or loss. So this credit side is realization loss.
Yes, sir.
It's a loss to you. Now remember, in the question they said that receivables have agreed to what? Pay how much? 1,500.
Receivables. Okay.
Oh, read on.
Receivables of 20,000. Debtors agreed to settle 1,500 in full.
Oh, sorry. But
If
receivable is 10,000. Then that means our narration.
receivable of 20,000.
No, then we should change it here because the receivables is the receivables. The receivable is 10,000 in the question.
Yes, in the question.
So 10,000. So they decided to settle, let's assume out of 10,000, they decided to settle 800. Put it that way. If agreed.
800.
You understand?
Okay.
So they decided to what? Settle how much?
800.
800. Please, you understand? So
Yes.
this is how you go about it. It is two options. It is two options.
Thank you.
So they decided to settle 800. So if they decide to settle 800 out of 10,000, they are settling how much? 800.
800.
You understand? So you can simply bring it down here. Have you seen it? You can simply bring it down here and you say receivables. Then you bring how much? They say they want to settle how much?
800.
So they want to settle 800 out of
10,000.
10,000. What is it? The 10,000 is here. Please, have you
Yes.
seen it? Uh-huh.
Yes, sir.
So here, there are two methods of doing it, but I will not waste so much time here. So all that you have to do is your receivable is here. So they want to settle. How much are they settling? So you'll bring your what?
800.
So your receivables
Okay.
paid is how much? How much is paid?
800, sir.
Or you bring 800 here. Do you understand?
Okay.
Do you
Yes,
understand?
sir.
Because
Yes, sir.
do you know why? When you bring it here, you know that it will reduce this 10,000 by 200.
Okay.
You understand? You know that it will reduce this 10,000 by 200. So here, let's make it 8,000 here. Let's make this one 8,000. So here should be 8,000, right? Okay,
Yes, sir.
good. So here, we can decide to do it in two methods. I can decide to come here. Have you seen this 10,000 here?
Yes, sir.
I can
The
decide to come.
receiver.
I receive it, then I can come and remove the 8,000 from it. The balance will be the receivables, which is 200,
It,
2,000
it's
receivables.
true. It's true.
You understand? So now they
Yeah.
are. So the reason why I don't want to bring it here is that you may forget. Have you seen this receivable paid here? 8,000. Have you seen it is at the credit side? So
Yes.
once it is paid, it will increase your what? Your cash balance in the book of what?
Sure.
Of the seller. Do you understand? And again,
Yeah.
when have you seen that this receivable is paid, it will also reduce your what? Your realization losses as well.
Listen.
Please, do you understand? Because if this one
Sure.
is not paid, you will see that the balance CD will be higher. But once it is paid, it will increase this one and reduce your what? It reduce this value. Are you
Okay.
with me? Are you with me?
Yes,
So
sir.
have you seen that because part of this asset has been settled, it will reduce our what? Our losses. Are you following me?
Yes, sir.
Aha. So do the math and let me see.
156334.
Go. You can term it as what? You can term it as what? Realization loss or sundry members. Do you understand?
Yes, sir.
Good. How much is it?
156334.
156.
334.
Like this. Okay. So have you seen this? So after you are done with realization, then you come and open your what? Your sundry members. Now, when you open your sundry members, you will come and do these things. Watch here. How many? What type of your equity? Your equity. You have your what? You have ordinary.
Stated capital
You have ordinary
preferential.
shares, and you have what? Preference what? shares. Then you will bring their balances from the balance sheet. The balance sheet balance for ordinary shares how much? And from the book is how much? 200,000, right?
100,000.
And the preference share is how much? 40,000.
40,000.
Are you with me?
Yes, sir.
Good. When you are done, let's go up. Let's go up again. Let's go up again. I will bring something here. Watch me. I will bring something here. What am I bringing here? Have you seen that there's a preference shares here? Preference shares, they decided to what? Settle one through what? Equity, and one through what? Through cash. Have you seen it? You remember?
Yes, sir.
Preference share, you remember. Have you seen what they did over there?
Yeah, no
When you
two.
are faced with that, the one with the cash, what is settled in cash, it must have a corresponding entry. Watch here. Accounting is debit and credit. Are you with me?
Yes, boss.
Okay. Once you debit, it should have a corresponding entry at the credit side. You remember that?
Yes, sir.
When they were paying, watch here. When they were paying for the cash on their equity, what did we do? We credited, where is it? We debited the what? The bank account of what? Of the company B. 20,000. You remember that? Okay.
Sure.
Now, when you come to the corresponding entry, will go into realization account as what? Preference shares at the credit side. Paid in cash, which is how much? Which is how much?
Preference share paid in
20,000.
cash. 1,000.
20,000. 20,000. Watch it here. We calculated it down here. Have you seen it?
Okay. Okay.
Aha. So
Fine.
20,000. So that is a corresponding entry to that. So take note of that. This is not a common entry that you will see. It's one of the uncommon ones. So please, less the 20,000 from 156,000. What do we have? So that should change the what? Our realization balance here.
The narrative.
How much did we get? 1, 3,
136. 136.
136.
334.
Okay, so this is how your balance will look. Now, let's go into the what? Into our this. Now, this is how you have. So you have your balance CD here, balance brought down, blah blah blah, and you have it here like that, right? Okay, so assuming we have income surplus, which is negative, it will come to the debit side of the sundry members. You understand?
Okay.
But we don't have any income surplus, which is negative. So there's nothing like that in the question. So when you are done, have you seen this balance here? Have you seen this balance here? Realization loss or members? Have you seen it?
Yes.
Then you will bring it here. Any question? Here too, we have ordinary shares and we have what? Preference shares. Also here. You underline them. You go to the balance sheet, then you bring all these balances here, right? So when you are done, then you also look at the item that must come here. One of the items that must come here is what? The preference shares that you paid in cash. Have you seen that it is at the credit side of realization account?
Preference share.
Preference shares that we paid in cash.
Yes.
Go to realization. Have you seen that it is at what? It's at the credit side. This one.
Sure. Sure.
Aha. That one is 20,000. Then you will bring it at what? At the credit side here. You call
Side
it
of
what?
the sundry member.
Yeah, then you call it what? Realization. That one is how much? 20,000 here. Done. Then you balance it off. That's all. So when you balance these two off, how do we go about it? So let us first balance ordinary shares off. When we are done, then we balance the what? Preference shares also off. So here you have what? Our realization loss.
Mm-hmm.
It is at the credit side. We will come to the debit side. So how much is it? 13.
136.
13. Oh no.
136. 334. 136,000.
334.
334.
So this is how it should have been. Then we balance it off.
Okay.
That's all that I wanted us to do.
Okay.
Uh-huh.
So you said preference what?
Preference what?
What loss is there? Realization loss or what?
Yeah, realization loss.
Thank you. Let me do that.
Okay. So here will be 40,000. Here will be 40,000. Here will still be 20,000. Sorry, three, four. No, you add it. So what is the balance? Here is 200,000. So what is the balance? So that's all. So here will be what? Balance CD. So you close this one, you close them one by one. So here is 20,000 here already. Now close the ordinary shares here for me. Realization loss at the credit side will come to the debit side of sundry members.
I understand that one.
And it will come under ordinary shares as you've seen it here.
Yes.
So when you are done, how do you close account?
And
Pay.
this is okay. So you find the difference.
Yeah, you find the difference. That's all.
It's okay. 63666.
63666 like this. So you see
Yes,
your
sir.
what? Your balance brought down. Here will be what? 63666. And this one will be what? Here is what? 20,000.
Yes.
Here is what? Balance CD. So here will be 20,000 as well. That's all. So this is all that I wanted you to do. Now the capital, the amount that will go to company B is what I'm saying. So here you go to purchase consideration. Go there. How much did we invest in what? In company B? What do you call it? In company B under ordinary share 50,000.
50,000.
And how much is preference shares?
666.
Six like that. Cash or something like that. So the difference between this one would have maybe 13666 difference here. You understand?
Yes, sir.
That would have gone to what? To the bank account. That would have gone to what? To the bank account. That's okay.
Okay.
So here, yeah, the preference share would have been 0. Simple. Okay. Now let me show you the alternative of this one that I was talking about. Sundry members. Now, sundry members, the alternative would have been like this. You would have picked the what? Share capital or capital. What here? You would have done it this way. Follow me here. Would have done this way. You would have picked. Hello?
Yes, I'm here.
Good. Would have picked both the equity and then preference share here. Would have brought them here. You add the two. What do you have?
Equity and preferences.
What do you have? When you add the two, what do you have?
56, 666.
No. Go to the balance sheet itself.
Okay. We have 240.
240 here. If you have any income surplus, which is negative, we would have brought here, right? Okay. Now we didn't have. So here, what do we do here? You will come here. Are you following me? You will come
Yeah.
here. Now, when you come here, you will pick the realization loss that we have in the what? In the realization. So realization loss is how much? What do you have?
Realization loss that we made. That is what gives us the
136.3.
1313.
So 136
334.
334 like this, right? Good.
Yes.
And remember, in that same we were having what? A realization on what? On share on share preference share, right?
Yes, sir.
Remember, we paid cash in preference share. How much was it?
We pay cash in preference share. So wait till I'm coming.
Oh, watch here. It
That
is in the
will be
realization
20,
account.
20. It is in
20,000.
a
20,000. Have you seen it?
yes.
Good. So when you are done also, then you also check how much are we investing in what? In the new capital or new company. how much, right? So here you see that the share capital was how much? 50,000. And then the preference share is how much? 666. Are you with me?
Yes, sir.
When you are done, so that is all. When you are done, then you balance it off. All that you have to do is that you pick the old equity share of what? Of the company.
Sir, the value is 213.
Which one here?
Yes.
So if it is
213.
so
Zero.
what here? So 240,000. 240,000. Then you find the difference of 213 over 240 is how much?
I'm doing it. 27,000.
27,000. So this is what your balance. So this is what I'm talking about, that it will go to cash.
Okay.
Cash or bank. So this is what I'm talking about. Do what? Cash account, cash or bank.
We can't use the old one, sir.
Which one?
The one when you were doing company B.
No. We are done with what company? No, you don't use the old one. Oh.
Thank you.
This one is for company B. You are talking about cash account.
Yes, cash or bank.
Yes, that one. This one is for company. The company B will close because there's nothing to enter here. Sure.
Okay.
This one will close. So balance CD will be what? 20,000. The account will close like that. Okay. So now watch here. When you come to the account of what? Of the company A. So you will bring your what? Your balance brought down. You go into the balance sheet and see if there's a cash. The cash is how much? 20,000, right?
Yes, sir.
So the cash is 20,000. Good. And remember, I said that come here, come to realization. I said that some of the receivables are paid. How much? 8,000. You remember? Out of 10,000, 8,000 is paid. You remember?
Sure.
So you bring down what? Receivables here. 8,000. Right? Good. When you are done, then you go to the what? You go to the summary. Have you seen the summary?
The
Sundry
summary is
members.
sundry.
Now, sundry members, have you seen that the balance here is what? Cash or bank? Have you seen it?
Yes.
Then you will bring it here. Sundry members. How much? 27,000. Do you understand? And
Yes.
remember, I also told you that when you come to realization, there is what? There is reconstruction cost of 1,000. Have you seen it?
Yes.
It is expense that the company A has to pay. That one is how much?
Thousands, sir.
So that's what reconstruction what expense, which is how much? 1,000 cedis. The balance, it should balance in the cash book. If you don't balance it, then it is wrong. Your work is wrong. So you should balance it in the what?
Sir, let's check this one. On
So
the debit side.
you and the
What
best
is there? On the debit side, what is the 20,000?
20,000 is balance brought down from the balance sheet.
Thank you.
Plus 8,000 is how much?
Plus 28,000.
28,000. And this one is how much?
The same value, sir.
So it is balanced.
Yes, sir.
You understand?
Yes, sir.
This one, I said this question from my head, but you see that the
Yeah.
account is balanced.
It is not easy.
So at the end of the day, your cash book should balance the account. So if your cash book is not balanced, then there's a problem with what? With your workings here.
It's true.
This question, I set it from my head. But you see,
Direct.
I'm telling you.
It's not easy.
I'm telling you. I just decided to
It
use
is
that
not
one.
easy.
I just decided this one to just to. So now when you are done, before then you come to your what? Your what do you call it? Company B, which is the acquirer. Statement of what?
Financial position, sir.
Position. Okay. You'll start with what? Your non-current assets. Non-current, you have what? You have your tangible asset, right?
Yes, sir.
Your tangible assets. How much is your tangible assets? You have non-tangible, intangible assets.
Okay, I have 100,000 and 50,000.
Okay, this one is 100,000, and this one is 150,000, right?
Yes, sir.
Okay. Now remember, I said that you should reserve goodwill.
Sure.
You remember? Okay, good. When you are done, then you come to parent asset. Parent asset, what do we have?
Inventory, sir.
So inventory, how much is inventory?
Inventory is giving me here, I think 60,000.
60 60,000.
Yes.
Okay. How about receivable? Remember, receivable is settled.
Yes, 10,000.
You understand? Receivable
Yeah.
is settled. We settle, so it will not come here
At all.
at all. You understand? Then you will bring your what? Your cash or your bank. Remember, your cash and bank is what? In the book of what? B. You remember that I said your cash and bank is here. Where is it? Here. This one. This 20,000. Have you seen it? Have you
Okay.
seen it? Have you seen the money that they paid for preference shares? Aha. So that will come here. When you add, you have 80,000. You add it up. What do you have? When you are done, then you come to your what? Your equity.
Okay.
So you have your what? Your share capital.
Share preference share.
No, you add it. The total equity share. That's all. So the total equity share, if you really want your total equity share, you look at the purchase consideration, the shares calculation that we did over there. Something. So this is your
Correct.
what? Your shares. So there's no other apart from share capital. There's nothing again in there. Or is there anything? There's nothing.
No, sir. No, sir.
Uh-huh. You add it up. It will not balance though, but it's better that way.
Yes, it's okay. Showing you
Remember,
that.
yeah, no. Then you come to your goodwill. Your good. How do we get the goodwill? Now, have you seen? Have you seen the reason why I told you that you relax on what on the item that you bring here? So here you come. You come here. You see that we don't have receivables again in the books. So
Sure.
your intangible is 100,000. Your intangible is what? Your tangible is 100,000. Your intangible is how much?
50,000, sir.
50,000. And then your inventory is what? 60,000. You add
50,000.
it. What do you have?
210.
210. Then you less from this one. How much?
210. 153,334.
Hey, 153,334. Like this.
Yes, sir.
So the intangible is more than the purchase consideration. You less this one from this one. And I'm saying that it means the total intangible asset is more than the purchase consideration. That's what
Sure,
I'm
sure,
asking.
sure. Sure,
So
sure.
so this is what we call negative
Goodwill.
goodwill. And this one we call it it will go to your reserve in your what in your equity. Understood?
Yes, sir. Let me put down inventory.
Negative goodwill. So this goes to what your reserve. Okay, so here it will come here.
Which side of the?
Equity.
Oh, okay.
So how
Okay.
much is it?
153,334.
Okay, so you add it up. You add when you add this one, add it up. So here we got 230.
Yes.
Okay, and this one you add it. What do you have?
210.
This one is 210.
It's fair.
It's very very fair. So please, this is how we go about this. So Charlie, you take note of that. But I'm concerned about this place. Sundry members. The first one, if it will give you problem, stick to the second option. That one is simple. You understand?
Okay. Okay.
You go to the balance sheet, you add the preference shares and then the ordinary shares figure together. Then you bring it here
Okay.
as shares, right?
As one.
As one.
Mm.
When you are done, then you come here. When you come to the credit side, then you go to the purchase consideration, how much they are offering for shareholders and how much they are offering for equity, ordinary shareholders. Please, do you understand?
Yes,
Then you
boss.
bring it here. So when you bring it here, then other items that you need to bring it here, then those ones will follow.
Follow.
Please, do you understand this whole thing?
Yes, sir.
This is a question that I decided to use as a basis to
start up.
So tomorrow we will you handle a major question.
Thank you.
So this is a teaser for you.